Money printing is about to surge again, and when it does, crypto is set to explode like never before. Are you ready to ride the wave? In this video, we'll reveal why the next big market move is just around the corner and how you can position yourself to profit big. The current disconnect. The financial world is witnessing a striking divergence. Stock markets are soaring, while cryptocurrencies remain largely flat. This split puzzles many investors as both markets often move in tandem during bullish phases. The surge in stocks is driven by a handful of mega-cap companies dominating gains, whereas crypto assets, especially altcoins, struggle to find momentum. This disconnect highlights differing investor sentiment and capital flows. Stocks benefit from strong earnings and institutional buying, while crypto waits for renewed catalysts. Understanding this gap is crucial for anticipating where the next wave of investment might flow and recognizing potential opportunities in the crypto space once the stagnation ends. Why money printing is about to start again. Central banks worldwide are preparing to inject fresh liquidity into the economy as growth concerns and geopolitical tensions rise. Renewed quantitative easing or direct money printing aims to stabilize markets and stimulate spending. Inflation pressures have eased, giving policymakers room to act without stoking excessive price rises. This influx of capital typically fuels asset prices, including stocks and cryptocurrencies, by lowering borrowing costs and increasing investor risk appetite. The anticipation of fresh money entering the system creates an environment ripe for market rallies. Recognizing this upcoming liquidity wave helps investors position themselves ahead of major price movements. How liquidity drives both stocks and crypto. Liquidity acts as the lifeblood for financial markets, determining how easily assets can be bought or sold without impacting prices. When liquidity is abundant, investors have more capital to deploy, pushing prices higher. Both stocks and cryptocurrencies benefit from this influx, as increased money supply encourages risk-taking and asset accumulation. Conversely, liquidity shortages can lead to sharp sell-offs and volatility spikes. Central bank policies, fiscal stimulus, and investor sentiment all influence liquidity levels. Tracking liquidity trends provides insight into potential market momentum shifts and helps explain why certain assets outperform during specific economic cycles. What's fueling the rally? The S&P 500 recently hit record levels, driven primarily by a select group of technology giants with massive market capitalizations. These companies have delivered strong earnings growth, innovation breakthroughs, and dominant market positions, attracting significant investor interest. Additionally, low interest rates and accommodative monetary policies have made equities more attractive compared to bonds. Investor optimism about economic recovery and corporate profitability further supports the rally. However, the narrow leadership raises questions about the sustainability of gains if broader market participation does not follow. Understanding the drivers behind this surge is essential for evaluating future market directions. Why it matters for markets. A golden cross occurs when a short-term moving average crosses above a long-term moving average, signaling a potential bullish trend. This technical indicator often attracts momentum traders and signals growing investor confidence. In the context of major indices, the golden cross can mark the transition from a corrective phase to sustained upward movement. While not foolproof, it has historically preceded significant rallies. Market participants watch this pattern closely, as it can influence buying behavior and sentiment. Recognizing the golden cross helps investors time entries and gauge the strength of ongoing trends in both stocks and crypto markets. Market breadth. Market breadth measures how many stocks participate in a market rally, offering insight into its health and sustainability. Currently, the rally is heavily skewed towards a few mega-cap tech companies, while the majority of stocks lag behind. This concentration suggests a fragile rally, vulnerable if those leaders falter. A strong market breadth, where many stocks advance, signals broad investor confidence and a more resilient uptrend. Monitoring breadth helps identify whether gains are widespread or narrowly focused, guiding investment decisions and risk management. It also sheds light on potential rotation opportunities as investors seek value beyond the dominant players. The rotation phenomenon. Market cycles often feature rotations where capital shifts from large, established companies to smaller, more speculative stocks. After extended rallies in megacaps, investors look for fresh growth opportunities in undervalued or overlooked sectors. This rotation can signal a maturing bull market and broadening participation. Small-cap stocks tend to outperform during economic expansions due to higher growth potential. Observing this pattern helps anticipate shifts in market leadership and adjust portfolios accordingly. In parallel, similar rotations can occur in crypto, moving interest from dominant coins to promising altcoins, setting the stage for explosive gains in the next phase. Wait a moment. What's your take on the current gap between soaring stocks and quiet crypto? Let me know your thoughts in the comments below. Share your thoughts with us. Lessons from past market recoveries. Historical market recoveries reveal patterns that can guide current investment strategies. Typically, rebounds start with strong leadership from large-cap stocks, followed by a broader market participation as confidence grows. Early phases often experience volatility and sector rotations, reflecting shifting investor preferences. Recognizing these stages helps anticipate when to diversify and when to focus on growth areas. Past recoveries also highlight the importance of staying invested through downturns to capture long-term gains. Learning from previous cycles provides valuable insights into timing, risk management, and identifying emerging opportunities across asset classes, including the interplay between traditional markets and cryptocurrencies. Why small caps could be next. The Russell 2000 Index, representing small-cap stocks, often leads in the next phase of market rallies after large-cap dominance. Small companies typically benefit from economic expansions with faster growth potential and greater sensitivity to domestic trends. When investors seek fresh opportunities beyond megacaps, capital flows into this segment, driving outsized returns. Historically, a rotation into small caps signals increased market breadth and confidence in sustained economic recovery. Monitoring the Russell 2000's performance provides clues about shifting investor sentiment and potential spillover effects into riskier assets like altcoins, which share similar growth characteristics and appeal during bullish cycles. How stock market trends signal crypto moves. Stock market behavior frequently influences cryptocurrency trends due to overlapping investor bases and macroeconomic factors. Bullish momentum in equities often boosts risk appetite, encouraging capital inflows into crypto assets. Conversely, stock market corrections can trigger crypto sell-offs as investors reduce exposure to volatile assets. Technical indicators and sector rotations in stocks may precede similar movements in crypto, especially among altcoins. Tracking key stock indices and market sentiment offers valuable foresight into crypto market cycles. Understanding this relationship enables investors to anticipate entry points and manage risk effectively by aligning crypto strategies with broader financial trends. Bitcoin and altcoins. Bitcoin and altcoins exhibit varying degrees of correlation with traditional financial markets. Bitcoin often behaves like a digital gold, showing moderate correlation with equities during risk-on environments, but also acting as a hedge in some scenarios. Altcoins, however, tend to be more sensitive to speculative flows and broader market sentiment, often amplifying trends seen in stocks. This dynamic means shifts in interest rates, liquidity, and investor confidence in traditional markets can ripple through the crypto ecosystem. Recognizing these correlations helps investors balance portfolios, anticipate volatility, and identify when crypto assets may decouple or align with conventional market movements. Why altcoins are poised for a breakout. Altcoins are positioned for a significant breakout due to several converging factors. After prolonged consolidation, many altcoins have developed stronger fundamentals, including improved technology, real-world use cases, and growing adoption. Market cycles suggest that once large-cap cryptocurrencies stabilize or peak, capital rotates into smaller, high-growth tokens. Additionally, increased institutional interest and regulatory clarity are reducing barriers for mainstream participation. This environment creates fertile ground for altcoins to outperform, delivering substantial gains as investors seek diversification beyond Bitcoin. Timing this breakout requires monitoring market sentiment, liquidity flows, and emerging trends within the crypto space. Building the ultimate crypto and stocks portfolio. An optimal portfolio balances growth potential with risk management by combining stocks and cryptocurrencies. Stocks provide stability, dividends, and exposure to established industries, while crypto offers high volatility and asymmetric upside. Diversification across sectors and asset classes reduces overall risk and captures multiple growth drivers. Strategic allocation depends on individual risk tolerance, investment horizon, and market conditions. Incorporating both large-cap equities and promising altcoins allows investors to benefit from traditional economic recovery and disruptive innovation simultaneously. Regular portfolio reviews and rebalancing ensure alignment with evolving market dynamics and personal financial goals. Why patience in crypto pays off. Patience is a critical virtue in cryptocurrency investing due to the market's inherent volatility and cyclical nature. Long-term holders often reap substantial rewards by enduring short-term fluctuations and waiting for fundamental developments to unfold. Market consolidation phases can be frustrating, but serve as necessary groundwork for future rallies. Staying invested through downturns allows participation in explosive growth periods driven by technological advancements and increased adoption. Emotional discipline, combined with informed decision-making, helps investors avoid panic selling and capitalize on the market's full potential. Cultivating staying power is essential for navigating crypto's unique risk-reward landscape. Thanks for watching. Stay tuned and stay ready. When money printing kicks in, crypto's explosion will be unstoppable. Don't miss out on the next big wave. Hit subscribe and join us for all the latest updates.